On today's episode,
there are these drivers that could be a massive catalysts for the huge growth of the stablecoin ecosystem and stablecoins as an asset class. So it just remains to be seen when and how quickly that will happen. But we're quite bullish. I think that we are at the cusp of this quote-unquote revolution.
Welcome to the Active Share podcast that explores less obvious investing insights in a world that's always changing. I'm your host, Hugo Scott-Gall. Today, I'm very pleased to welcome Martin Bruncko to the show. Martin is the CEO and founder of Schuman Financial, but his journey spans far beyond the boardroom. A serial tech entrepreneur and investor, Martin has shaped the future of digital finance as director for Europe at Binance and helped steer national policy as Slovakia's innovation minister and deputy finance minister. And if that wasn't enough, Martin holds a double major with honors and university distinction from Stanford and made history as the first Slovak to graduate from Harvard. We're thrilled to have him here to talk about innovation leadership and the future of finance. Martin, thank you for coming on the show.
It's great to be here. Thank you, Hugo.
Great. We've got lots to talk about, but I want to start with really how you got to here. You've worked in government, you've worked in tech, you've worked on flying cars, you've worked on really deep technological challenges. What drives you to be an entrepreneur and what drives you to have such an eclectic range of working experiences?
Thanks for that. And I think the short answer is I like to do things that are really changing the world or the society, or at least the part of the society that I'm a part of, at a large scale. And I think that would be the one common thread between both the government jobs, actually, for that matter, even nonprofit, and then for sure all the entrepreneurial stuff I have done over the past, 15, 20 years.
If you look at countries like Singapore, they have a very open door between the private sector and government. They have obviously I don't think it's an exaggeration to say, clearly very talented people in government. Do you think governments in Europe would do better if they had more interaction between the two sectors and more movement of people?
I think they would do better if they got better people in the government, with respect. There are some countries like UK, for example, which is a very high quality public or civil service. I think probably Nordics would be the same, but there's many countries that would definitely benefit from much better people in the government. And in fact, when I was in the government, inspired by Singapore, we launched a scholarship for students from Slovakia who would get into world's best universities like, the Harvards, the Princetons of this world. And we would pay the full scholarship for them to study at these universities in exchange for them then coming back and getting senior roles in the government. Unfortunately, not all the governments in Slovakia have been this enlightened. And we've had a kind of a populist left-wing government that came after us, and they just shut down the scholarship. For sure, I think this is the right approach. Everything that you do depends on the quality of the people that you surround yourself with, or rather even people who are actually executing and delivering.
If we think about Europe, most countries have a growth problem. If you think about most modern democracies in a post-industrial age, they have growth challenges. Do you think there's enough, and we're going to talk about one of your solutions to this in a minute, but do you think there's enough urgency when you look across the European landscape at the need to innovate, to generate growth?
I don't think so. I can't judge for Europe generally speaking. I live in France right now, and it's quite horrifying actually how little or no urgency and no focus there is on growth, right? The whole focus is on redistribution. And I think this is the problem of Europe, that we've become more fat, more lazy. We as societies, as governments certainly. And again, just sitting here in France, the public spending in this country is 57% of GDP, as opposed to, less than 40% in the US and less than 50% in some of the most or the fastest growing European economies, including those in Central and Eastern Europe.
So you've got I would argue, a highly innovative solution to pain points and also a enabler and a catalyst for growth. So let's talk about Schuman Financial. What is it? What's the problem you're trying to solve? What's your product?
So we are the largest ecosystem with the largest independent European euro stablecoin. We're regulated out of France by effectively the Central Bank of France, audited by KPMG. And effectively, we have an EMI license, so electronic money institutional license, to issue stablecoins and to provide related e-money/payment services directly related to the euro stablecoin. And the problem we're trying to solve is actually very simple. I mean, we do deeply believe that financial services are moving on chain, and they will end up, most of the financial services will end up on chain, just as most of the non-financial services ended up on the internet, simply because just as internet is a much better technology for storing and moving information, the DLT, digital ledger technologies, or blockchain is just a much better technology for storing and moving financial value. And we've still been until now in very early stages of the development of the technology. But as the technology is becoming more and more mature, more and more financial services will move on chain. Now, given that euro-denominated financial services globally are roughly a third of the size of the dollar-denominated financial services, I mean, obviously it depends on different specific markets/services, but given how huge they are globally, if financial services and when they move on chain, the euro-denominated financial services will need to be executed, will need to be settled against euro on chain, which is basically a euro stablecoin. And that's what we're building. We're building this infrastructure, the core infrastructure for the future of finance, which we are convinced will inevitably end up on chain.
So let's do a quick 20 seconds teaching on stablecoin.
So what is a stablecoin? I mean, stablecoin is effectively a token, a digital token issued on the blockchain, and it's backed one-to-one with a specific fiat or government issued currency, right? So a euro stablecoin, it's basically a version of the euro on the blockchain, where for every single euro stablecoin that was issued, the issuer collects one actual euro and keeps it in reserves in order to guarantee the peg. So in order to make sure that the value of the stablecoin is stable, that it's always one-to-one. And again, the way you can guarantee that is by making sure that you always have at least one fiat currency per every stablecoin issued in your reserves.
And when it comes to the use cases, is it payments? Is it cross-border settlement? What do you think are the obvious use cases?
I mean, it will be all of the above, right? Where the initial use case that's actually quite taking off is in payments, and particularly cross-border payments, because it's just much faster and much more efficient way of executing payments. Because if you just do wallet to wallet or digital wallet to digital wallet payment using a stable coin, it settles effectively within a few seconds between these wallets, no matter where the holders of these wallets are. So if you're sending €1 from France to Slovakia, sometimes it can be instant. Usually it's not. Usually it takes longer. But if you're sending €1 from Namibia to Peru, I bet you it's going to take at least a week. With a euro stablecoin, it's going to take a couple of seconds.
Blockchain has been talked about for quite a while as a technology to produce rapid transactions, almost friction-free at much, much lower costs. But it's taken time. What do you think now that there are euro stablecoins? Obviously, there are dollar stablecoins. What are the adoption barriers? What's stopping this becoming highly used and therefore exponentially growing?
I mean, the main barrier still is that the actual underlying financial services are not really, massively moved on the blockchain, right? They're still executed using the old legacy systems. Dollar stablecoins are quite large as a market simply because the dollar stablecoins have historically been moved, and until now, essentially almost uniquely for use cases related to trading of crypto assets. And the trade of crypto assets had been denominated historically in US dollars, just like some commodity markets, etc. And so because of that, you have a very big market of dollar stablecoins. But again, that market is still tiny compared to how large that market will be and the stablecoin market overall once the financial services, traditional, normal, quote unquote, financial services start to move on chain more extensively.
And the adoption path is how much of that is contingent upon regulation and how much is actually adoption by key users?
So I don't think it's really regulation. I mean, regulation is critical in the sense that it provides clarity in terms of what you can and cannot do with that product. So, but that's in place. Europe actually has been a global leader in this with the MiCA regulatory framework, which came to force a couple of years ago, actually, and parts of it last year. But overall, I would say that the real blocker is really kind of the state of the technology. I mean, it's just like with the internet, right? Like the internet was sort of there already in the late 90s, but people haven't really figured out all the things, all the tricks of how to provide the kind of normal quote unquote services on the internet, because it required a lot of innovations in other areas, whether it was logistics, delivery, etc. Mobile phones didn't exist. And I think we're kind of in the similar stage right now with blockchain, with stablecoins, that all these relevant and related aspects of providing financial services on chains, people are starting to really figure them out. And I expect that within the next couple of years, there will be a exponential growth of these financial services on the blockchains and therefore also of stablecoins.
How much of a driver is a desire to get out of a dollarized system? So dollar debasement, US fiscal position deterioration, or is that the wrong question? The right question is, if Europe doesn't do this, the euro will just become a lot less relevant.
Yeah, I think that's a much better question. I mean, the first question is a good question. That's actually, conceptually speaking, it's a very interesting question. I don't think that's actually really a big driver right now, simply because, again, the real driver is the underlying financial services kind of being provided on chain, and doesn't matter in what currency, right? But indeed, the second question is really, really interesting one, which is because indeed, if most of the financial services will be provided on chain, and Europe is a laggard in this technology, if we don't have like advanced infrastructure to provide euro-denominated financial services on chain, then indeed Europe will become a global laggard. And global laggard, like literally, the role of the euro globally will be declining, right? Because there is a lot of countries where euro-denominated financial services are in use. I mean, one example could be parts of Western Northern Africa. And yeah, for sure, if the euro on chain, so to speak, doesn't really advance properly, particularly if it's blocked, for example, by regulators, then indeed dollar will come in and the role of the euro globally will decline.
Is there a benefit? So thinking about incentives, clearly not becoming irrelevant, the fear of irrelevance should be an incentive, but for governments and how they finance themselves, do you think stable coins make it easier for governments to finance themselves and maybe even change the cost of capital?
Oh, for sure. And I think this is definitely one of the reasons why the current US administration has been so pro stablecoin, because indeed, effectively in US and certainly in Europe, the regulations say that if you're issuing stablecoins and you have all these reserves which serve to collateralize your stablecoin, the reserves need to be invested in highly liquid and low risk assets. It's effectively government bonds. And you can already see it in the US, where Tether, which is the largest issuer of stablecoins in the world, they're dollar denominated, is also one of the largest buyers of government debt, right? So if this asset class grows by a couple of orders of magnitudes, which I think it will, that means that it will also create a huge demand for government debt. So indeed, this is a very positive thing for today's governments, which are very heavily indebted. And actually, sadly, it's a point that European leaders sadly have not quite grasped yet. But on the flip side, I think once they start to realize that, oh, here we have a really nice source of government debt financing, they'll probably open their arms much more widely to stablecoins and stablecoin adoption.
Can we talk a bit about AI? That in a world where there is genuine agentic AI, everyone has an agent, and the agent does an awful lot for them. It's concierge, assistant, advisor, curator, and all the rest. There must be a role for stablecoins as payments in that world, and if obviously you'd be reliant on the technology to deliver agentic AI, but once it's here, the use case really increases for blockchain technology stablecoins.
Yeah, no, 100%. I'm a big believer in that as well. I mean, simply because stablecoins, unlike normal money, stablecoins are programmable money. So you can really program this money to execute based on a preset set of criteria. And indeed, as these agents, digital automated agents, start to interact between themselves, it's a natural way of executing payments for these services, particularly between them, right, in an automated and pre-programmed way.
But I think what I'm driving at is that, I just asked you a conceptual question, but in that agentic AI world, maybe we all have one agent that we trust, or maybe we have several, whatever. It'll change very, very quickly. If you think about how quickly Facebook got to 500 million users, OpenAI, etc., these things can happen very, very fast. And so if you combine the benefits to government plus the use case of a fully digital, agentic experience, then the growth could be really, really rapid. And therefore the pressure on governments to make sure that they don't get in the way for this to happen would be quite considerable, particularly if there are clear benefits. So I don't want to paint too bullish a picture or kind of lead you down too bullish of a path, but this could really look very different within 5 years.
I mean, it's like with mobile phones, right? Or smartphones. They kind of had been around, all kinds of manufacturers, Nokia, BlackBerry tried to create these smartphones. It was sort of working, but definitely wasn't world changing until basically Apple came up with a very nice version of the smartphone. So that was the catalyst. And then 5 years later, each and single person almost on the planet, well, at least in the Western world or in the northern part of the planet, had a smartphone, right? And things for which we required different devices, from GPS to digital payments, suddenly we had them all in our pockets. And so I think that's in the same way, there are these drivers that could be a massive catalyst for the huge growth of the stablecoin ecosystem and stablecoins as an asset class. So it just remains to be seen when and how quickly that will happen. But we're quite bullish. I think that we are at the cusp of this quote unquote revolution.
So let's say that the revolution is coming. It'll be digitized, not televised. Who definitely loses?
Good question, right? I mean, look, it's one of those technologies where if existing companies adapt and those that are most at risk of losing, they could continue being winners, right? So it means effectively legacy companies in financial services, whether it's banks or car networks like Visa, MasterCard, right? So it could be a huge catalyst for them. Or if they don't adapt, then it could be quite disruptive. I mean, same way as the kind of the first fintech version was disruptive for certain financial institutions. I mean, one even good example is it's brokerages, right? With those, and notably, I guess it was Schwab, which was not really a digital brokerage, but they managed to adopt this technology effectively and fast, and they are still a massive global player. I don't know, possibly much bigger, relatively speaking, than they were before. There were those brokerages that never adapted to the advent of the internet, and they're presumably gone by now.
For sure. Do there need to be moments of great stress on the system that it comes through strongly to prove the use case? Do you think it's there are these kind of moments of maturity where the system is stressed and it performs versus not performing? Has that happened, or do you think that needs to happen?
If we take the existing system, right, is it performing versus, and is there a new technology which would perform? I think financial services, traditional financial services, and the systems we've had, the legacy systems, they've developed over such long periods of time, decades, even more than that I think, and they've been regulated and looked at from so many areas that I think they're pretty resilient. So in that sense, I'm not sure if there's like an obvious type of crisis where these legacy systems would fail and this blockchain-based technology would prove that they are so much more superior. To me, again, it's more akin to the internet, where it's just a better technology for certain aspect of economic activity. Again, in this case, for just much better technology for moving and storing financial value. And people realize and over time build up new applications, and eventually, like with the internet, like you look around, everything is on the internet, so to speak. I think 10 years from now, certainly 20 years from now, when you look around, kind of everything will be on the blockchain.
Where do central bank digital currencies fit in?
So I think they have some use cases possibly for wholesale finance, particularly transfer between the central bank and then the individual banks. But personally, I'm not a huge believer in CBDCs. The main reason for me is that it partly are these national currencies on the blockchain. Partially they are infrastructure, but they're also very embedded in this, quote unquote application layer. So it's not one of those technologies you build it and then everybody just adopts it. I think it requires for people to start using euro or dollar on chain in traditional financial services. That requires a lot of business development. It requires a lot of hand holding. It requires building up a lot of customized infrastructure for these providers. And I just don't see how whatever European Central Bank would hire a whole army of biz dev and account managers to work with the private sector on developing and spreading this technology. So to me, it just seems much more obvious and natural for private companies to do that, to push this technology forward, and again, and do it via euro on chain or digital euro on chain in the form of a stablecoin.
When you see meaningful shifts in technological capability and then the diffusion of that new technology or improved technology, business models get created that you wouldn't necessarily predict. When the engineers were making 4G, they didn't say we're doing this to enable Spotify and Uber, but that's what happened. What business models do you think are on the come as a result of what's changing now?
So this is a great question, and it goes back to the discussion we had before about the spread of this technology, like how quickly or how close we are to a massive spread of this technology. I think we're quite close to it because these equivalents of Uber and Spotify will appear in financial services. The problem is precisely that we don't know what they are. They are the known unknowns, I suppose. Just like people couldn't guess in 2000 the Uber and how important it will be. There are these use cases which, by definition, we still don't know what they are. But I think it's fair to say that there will be equivalent type of use cases. And once somebody figures them out and starts pushing their adoption, we'll all just kind of hold our hands and, oh my God, like this was so obvious. Like, why haven't I done it?
Yeah, I agree. You didn't, I don't think anyone in the 1980s, 1990s said, why don't I have in my pocket this thing that can enable me to stream any video clip, any bit of music that's ever been created? But turns out as soon as it was there, they knew they needed it. So I think it's fascinating, as an investor, when you have periods of faster diffusion, things are going to change. You don't know exactly how, but you can kind of peel it back to some things you do know for sure, which may well be that under any scenario, company A, B, and C just won't exist, or they certainly won't be able to be as profitable as they are now.
Yep.
That's one of the things we wrestle with. For you, that's less of a concern because you're more of a. We're dealing with public market companies who are probably what to define them as how they respond, how they adopt. Great incumbents adapt. Stale incumbents die. That's the question for us. You're more on the other side.
Yeah, and I think actually, in all fairness, I don't think we will have such dramatically visible examples of disruption like Uber or Spotify because these are consumer use cases. And a lot of the finance is consumer facing, but I think the technology is really kind of an underlying infrastructure type of technology. And so, the consumers, I'm sure there will be use cases that will be obvious and highly visible to consumers. But I think most of the disruption and revolution will be really coming at a kind of B2B level and basically a lot of savings and a lot faster services, kind of B2B, which I guess partially or ultimately will also translate into B2C.
Choke points on networks have always been nice places to invest, whether that's physical networks, whether that is virtual digital networks. So I guess there's some risk around that, or some risk of failure to adapt.
Yeah.
Let's finish up with just a few questions more about you, if you don't mind. You've worked cross-border, you've worked cross-industry. How have you evolved as a leader? And I'm always interested in asking people how they make decisions and have they got better at making decisions.
Well, I think I've become more chilled over time. So that's definitely one way how I evolved. Number two, I think I'm definitely a faster decision maker than I was before. So yeah, I guess that's number two. And number three, this is one of those like truisms that you hear from your first business or / management class in the university, how it's all about people you surround yourself with. And so yeah, I think I now pay even more attention to what people I surround myself with and the teams I build, because the better team you build, the less hard you have to work yourself to deliver the same outcomes, or at the same level of working hard, you just get much better outcomes.
It's interesting that you say that as you've got more and more deeper into technology, more and more it's the people that are really crucial. Have you got better at judging talent? Have you got better at assessing talent? Have you got better at evaluating talent?
Yeah, I've definitely gotten better at judging talent. I'm not sure if I have a better scientific method at judging talent. So I think it's just almost more intuitively I can kind of tell, usually, obviously not always, that like, yeah, this is going to be a great person to work with. That, this is the person I want to have on my team.
Okay, final question. Give me a book or a thinker that has really, I guess, influenced you and how you've lived your life and the choices you made, or several if you want.
Yeah. So, I mean, I studied literature at Stanford. It was one of my 2 degrees. And so the best book I think I've ever read until now is a book. It's very hard to come across in English. It's called The Etruscan, or actually the original title is The Immortal Turms, Turms, by a Finnish author called Mika Valtari, Waltari. It's a historical novel, but it's just a phenomenal book that probably has had, I think, most influence on my life in a way. And then, in terms of thinkers, I guess when I was young, but still, on the one hand, it's Nietzsche. But the other person who also had a lot of influence on me, which would be seen now, I guess, exactly the opposite side, given today's political divides, is George Soros, and who actually, by the way, also almost ended up getting a PhD in philosophy. And his tutor, I think, / advisor was Karl Popper, who's a philosopher of science. And so Soros was very influenced by him. And so I guess I could say that, Popper is also someone that has a lot of influence on the way I think.
Fantastic. Well, that's a great place to finish. I really appreciate you coming on the show. It's been great. One of life's true luxuries is to meet very smart, very interesting people. And you've checked that box. So thank you for coming on.
Well, thank you, Hugo. It was all my pleasure. I really enjoyed the conversation, and thank you.
Thank you for listening to today's episode of The Active Share. The Active Share is available on iTunes, Google Podcasts, TuneIn, and Spotify. And if you'd like, please leave us a review. To hear additional insights from William Blair Investment Management, visit us at active.williamblair.com and follow us on Instagram at WilliamBlairIM.
This content is for informational and educational purposes only and is not intended as investment advice or a recommendation to buy or sell any security or to adopt any investment strategy. Investment advice and recommendations can be provided only after careful consideration of investors' objectives, guidelines, and restrictions. The views and opinions expressed are those of the speakers as of the date of this recording, are subject to change without notice as economic and market conditions dictate, and may not reflect the views and opinions of other investment teams within William Blair Investment Management. Factual information has been obtained from sources we believe to be reliable, but its accuracy, completeness, or interpretation cannot be guaranteed. Any discussion of particular topics is not meant to be comprehensive and may be subject to change. This material may include forecasts, estimates, outlooks, projections, and other forward-looking statements. Due to a variety of factors, actual events may differ significantly from those presented. Past performance is not indicative of future results. Investing involves risk, including the possible loss of principal. Any investment or strategy mentioned herein may not be suitable for every investor. References to specific companies are for illustrative purposes only and should not be construed as investment advice or a recommendation to buy or sell any security. William Blair Investment Management may or may not own any securities of the companies referenced. It should not be assumed that any investment in the companies referenced was or will be profitable.